We're in an environment where gold should be going higher. At least in present day terms, the inflation rate right now is 5%. And that's even that understated CPI. And yet the bond market keeps rallying. And so we have sharply negative real interest rates. And that's generally very good for gold. But yet now here we are at these sharply negative real rates and gold's going down.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Craig Hemke from TF Metals Report. Craig, thank you so much for joining us today.
Always nice to visit with you, my old friend. You're looking good.
Well, thank you. You too. And yeah, it's always great to visit with you. You have such great insights always. And your perspective kind of on the metals markets, because that's, what TF Metals Report is all about, kind of tracking what's happening in the metals space. We've seen a bit of a beating, as we talked about before we started recording, in the last couple of weeks. What do you make of why metals have been falling?
Well, man, I tell you, Elijah, this has been excruciating first half of the year for everybody in the precious metals. I think we all understood what happened at the end of last year as precious metals pulled back, because that's what happened at the end of 2019 as well. We got off to a good start, at least for a couple of days back in January. Then it's just been agonizing ever since. And what makes it particularly challenging now is we're in an environment where gold should be going higher. At least in present day terms, the inflation rate right now is 5%. And that's even that understated CPI. And yet the bond market keeps rallying. And so we have sharply negative real interest rates, which is that inflation adjusted rate where you subtract inflation from your annual bond yield. And that's generally very good for gold. I mean, the long-term correlation between real interest rates and gold prices is about 95%. But yet now here we are at these sharply negative real rates and gold's going down. I mean, Elijah, man, if we go back to January when I was putting out my forecast for this year based upon sharply negative real rates. If you'd have told me that by July we'd be sitting here, at negative 3%, I'd have thought, oh my goodness, oh wow, where's gold going to be? Well, instead gold's down 10% year to date. And so it's been very frustrating. We're kind of caught in a trap of what is essentially a covert, jawboned yield curve control by the Fed. As a way of keeping bond buyers interested in owning U.S. debt. There's got to be buyers if you're going to keep interest rates at these levels, which is what they need to do. If you're going to get them to do that, you got to get them to believe that all this inflation that they're seeing is temporary, transitory, not permanent. And that's what's happening at this point. People are actually believing in that. And I don't know, we'll see how much longer that stool is going to support them. But for now, that's the biggest problem. Gold isn't looking at current inflation. It's instead thinking that maybe inflation is going back to 1.5%. And so therefore, real rates aren't negative at all. That's what's kind of afflicting us.
Yeah, I mean, the month-to-month inflation rates are incredibly high, if annualized. And we're getting another the CPI out about next week. So pretty soon, if that number is even higher than the month before, I mean, what is your perspective on how gold could react?
Yeah, I mean, that's just it. I mean, it's like, the whole Chicken Little thing, or, the weatherman who's always, like the Weather Channel is always telling you, this is going to be the worst hurricane of all time, and then after a while, it kind of falls on deaf ears, right? Because, it ends up never being the worst hurricane of all time. And then all of a sudden the worst hurricane comes and catches everybody by surprise. And that's a little bit what the Fed is trying to. Remember, the Fed, Elijah, is always going to be reactive and not proactive, right? I mean, it wasn't until the markets crashed in 20, 20 in March with COVID that all of a sudden, here comes a QE. It wasn't until the market started to collapse in December of 2018 that they started talking about, reversing course on the little bit of tightening that they were doing. And so, when it comes to yield curve control and maintaining these low rates, which is what they have to do, they're not just going to go from, go to boardwalk in one move and just come straight out and say, we can't, we're not going to allow the 10-year note to go past 1.5%. There's going to be a series of steps, that they take before they have to go to that extreme. And one of them is just, where we are now, job owning. Trying to convince everybody, oh, the inflation you're seeing, don't look over here. Don't look over here. Look over here where we say it's going to come back down. And that's transitory is just another word for yield curve control. And the bond market, governments, hedge funds, institutions, and the like all buy it. Okay, sure. Okay, so we'll keep buying bonds. And long rates have actually fallen in the last 3 weeks from 160 down to 130. Elijah, that's almost like a 20% move. So the market is buying that. I tell you what, you get into next week, we get another CPI, with an even higher month over month and even higher annualized year over year. Okay, they'll try to write that one off too. And then what happens in August? So we're getting into a very increasingly interesting time of the year here with all this news.
Now, I guess what you're saying is we are seeing maybe kind of a disconnect between the real interest rates and gold, because normally they're negatively correlated, but we're seeing a disconnect suddenly because people are buying the Fed story that the inflation is going to be transitory.
Right. You know me, Elijah. I think the banks and the central banks always have an interest, whether it's just profit motive or whether it's perceived confidence in the fiat currency. They always have an interest in keeping the gold price in check. I don't know. Maybe that has to do with it too, because if gold was soaring on these negative real interest rates, how would that impact the transitory message? How can you claim inflation is transitory if gold's at $2,700 right now, which is where it could easily be with a negative 3.5% real? I mean, again, we were 2,100 at negative 1% last year. Okay, even if you measure inflation just off the anticipated, those break evens, as they call it, the expected future inflation rate. Even if you measure these real interest rates off of that, we are back to where we were at the peak last summer when gold was $300 higher. And again, if gold was $300 higher and making new all-time highs, how would that fit the transitory narrative? I don't know, maybe that has something to do with it too. But I think if anything, the biggest problem that we have right now is kind of structural. The Fed has this issue where they have to keep yields low out on this end, right? But they can't let yields go negative on the short end. And we were getting real close to that last month. We had, I think it was 4 one-month T-bill auctions in a row that priced at 0.000%. Okay? Can't go any lower without going negative. You've got all this cash that's been created through all this QE, and the debt the debt programs and the stimuluses and everything else. Would it be stimuli? I guess it probably would. Anyway, you've got all this cash sloshing around that there was more cash than there were places to put it. So you get this kind of crowding out, and this short end was threatening to go negative. That's why those T-bills were at 0. That's why all of a sudden you had this reverse repo facility start getting used in June, and it was $100 billion a night, and then it was $200 billion, and then it was $300 billion. The cash was just looking to go anywhere. Well, that was creating all this pressure on the Fed that they were going to get negative interest rates. And so the biggest, in real world problem for the precious metals right now, and really the markets in general, is in response to that, the Fed increased what they pay on overnight excess reserves. Okay. That allowed some place for this money to go. And now all of a sudden, last week at the end of the quarter, we're almost at $1 trillion of this overnight repo. That's $1 trillion. It's still maybe 800 billion a day. That could be out making in loans, right? And getting multiplied every time, as that works at the normal bank level. Could be invested in the stock market, could be invested in the bond market, could be invested in gold, all these different places. Instead, it's just being parked every night for 5 basis points. Okay, that's money that could be elsewhere. And so when the Fed raised, even though it was only 5 basis points, by doing that, they're inviting this overnight drain of liquidity, okay? And this $800 billion that could be going elsewhere and was going elsewhere 6 weeks ago is now just being tied up overnight. And that's starting to ripple through, not only in the metals where gold's down $100 from where it was 3 weeks ago before all this happened. Now you start to see some pressure in the stock market too. Okay, at one point the Dow was down 500 points today. Finished up, down 300, but it was down yesterday. Even today, with the dollar down, commodities were being dumped. Okay, so it's going to be, I'm real curious to see here what happens with the Fed. One other little thing I just got done talking about in my daily podcast to the members of TF Metals Report. Remember, we were talking about those short-term rates, Elijah, and the threat that they'd go negative. In response to the Fed pumping up that interest on excess reserves and raising this, what's called the effective federal funds rate from 5 basis points to 10, part of the response to that was the 2-year note. Okay, we're talking the real short end of the Treasury curve, the 2-year note, which since March of 2020 has kind of been in a band between about 15 and 18 basis points, 0.15 and 0.18. All of a sudden, 3 weeks ago, shot to 0.28, went screaming up in response to that. Okay, like short rates are going higher. The last 4 days, that thing's fallen back now and is now back under 20, down to 18 basis points, fallen back down. And so if the Fed has done this, and now we're getting all this old new cash, booting up short-term everything, and maybe nervous about the markets and all that kind of stuff, well, what will the Fed have to do next to keep rates from going negative? I mean, these are all things that when you run a gold site, you got to think about this stuff. So anyway, long answer. Sorry about that. But I just got done recording a 20-minute podcast where I talk nonstop, so now I'm imposing that upon you.
No, it's fantastic. We really appreciate all the insights there. And I guess one of the things that came to mind was that obviously we can't give financial advice, but if what you're saying is true, that kind of there's this perception out there that the Fed is going to be right, that it's transitory inflation. If we don't see that and inflation becomes more long-term, then right now seems to be a little time where no one's really looking at gold, but they're about to. So like right now might be a really good buying opportunity with the caveat, who knows really what the future holds, but it's possible that right now it's like no one's really looking at gold, but they're just about to.
That's some good contrarian stuff too, Elijah, right? You're supposed to rotate. Anybody, if you've ever taken any financial classes, you're supposed to always like sell some of your winners and buy some of your losers, average out of the ones that did best last year into the ones that did worst, because there's going to be always this rotation. We've seen some of that actually this year. It would have worked this year, right? And right now, man, the metals are just not. I remember telling somebody this not too long ago, and it still applies. You know what they say? The opposite of love is not hate; it's actually indifference. Right? Have you heard that one before? When you say that's where we are, I mean, it's not that the metals are hated; it's just nobody cares. And the mining shares are the same way. The shares are just like all you get every day is people selling them. And so, from a contrarian point of view, yeah, it's great. And I've always had this adage at TF Metals Report that if you're going to be trading the metals or the miners, you've always got, regardless how great things look, and this would have been true last August, you've always got to be prepared to sell some when things look great. But you've always got to be able to buy some too when things look the worst. And man, that's a very true adage in the precious metals and the miners. So to your point, yeah, that's kind of where we are. If it works out that and again, if the inflation continues like so many people think it's going to, the Fed's going to have to do more than just job owning. The yield curve control is going to have to go from kind of a covert to an overt stage, where they adjust. They've already done this a little bit, but where they say, okay, we're going to keep buying treasuries or maybe even buy a little bit less, but we're going to increase the amount we're buying at the long end. We're not going to crowd out on the short end. We're going to get out of the T-bills and the very short-term notes. We're going to start buying more the 7 and the 10 and the 20 and the 30 stuff and kind of adjust that barbell a little bit. That's a more active form of yield curve control, because it's like, well, geez, I don't want to sell too many bonds here because the Fed's buying and you don't want to fight the Fed, that kind of thing. And then as that begins to happen, then it's, that's when all of a sudden those sharply negative real rates become not just a transitory thing, but they become more permanent too. Yeah.
Now, with respect to, you mentioned the stock market earlier and how, it did, as we're recording this on Thursday, it did drop, but now it's a bit back up. Your perspective on, is that still a place that people kind of can ride out this bull market? Because if we're going to see continued stimulus from the Fed and more inflation and everything, that's been a big part of what's been driving the stock market up. So your perspective on investing in the stock market right now? Probably.
I think that there's definitely a Fed put underneath it, where we saw it as recently, like I mentioned, in December of 18. You can even say we saw it back in March of last year in the COVID thing. Everything's dumping. Then here comes the Fed with the fire hose and all the new alphabet soup of facilities and stuff to try to reinflate everything, reliquefy everything. You can bet that's coming again, because again, when they've chased everybody out of the bond market, and into this very short-term stuff. If you run a pension fund, public or private, you run an insurance company, a foundation, anybody that has always had yield, you've been forced into equities. You've been forced into high yield, just trying to get anything. And so the Fed can't afford any kind of a protracted recession or pullback in the stock market. And they're still fighting deflation. I mean, that was just a year ago. Wasn't even a year ago, actually. At Jackson Hole last year, where Powell was talking about, his biggest concern is this cycle of deflationary fears, deflationary expectation. Here comes the deflation. Here comes some more expectations of deflation. You can't get off that merry-go-round like Japan. And so if the stock market were to collapse 30%, how many trillions of dollars of market cap and of life savings and 401k plans would just evaporate? I mean, you talk about deflation. So that's one part of that. Will the stock market keep going up thing? Yeah. But then, too, anybody can look at their history or even look at present day. It's when you're hyperinflating your currency, hyper devaluing your currency, however you want to say it. That money goes somewhere. This is what the pattern was in Weimar Germany or current day Venezuela or Zimbabwe. And you're creating all this cash. And that creates inflation in financial assets, too. And so, I don't want to sound naive. I don't want to sound like I'm whistling past the graveyard. But everybody keeps waiting for this, oh boy, the market's going to crash and the Dow's going to go back to 10,000. Maybe, but that would only be if the central bankers of the world, not just the Fed, were just completely powerless to just overwhelm, turn on the machine and let it go burr,
And what are your thoughts on the possibility of dollar collapse, right? Because as we see, inflation get higher, I mean, the idea of just on your website, you talk about the great Keynesian experiment and how, you're watching the collapse of this. And some people might say, kind of be skeptical. Could we see hyperinflation here? Could we see any of those things? Your perspective on that, do you think that's actually a possibility in the near future? Or is that kind of, maybe decades down the road?
So I don't think it's decades down the road. But I don't know how to measure it in terms of near future either. But, there's a certainty in terms of math, as to how far you can exponentially drive things by just simply, devaluing your currency. I don't know what that point is. History has shown, though, Elijah, that you start with a currency that has confidence. I got to be willing to exchange my hard work and time and limited life expectancy for your currency that you're going to pay me in. Then I got to be willing to save in that currency, have confidence that it's going to retain some value so I can retain my savings. The people have to be willing to have confidence in the currency to transact in that currency. I'm not going to sell you anything, whether it's at the grocery store or anything else, if I think that, you're going to pay me $1,000 today, but that $1,000 only buy me $500 worth of goods tomorrow, like you get the guy with the wheelbarrow, full of Reichsmarks, right? So there is it's at the end of the day, I guess what I'm getting at is it's not a dollar collapse as much as it's a collapse of confidence is what you're talking about. And confidence wanes slowly. That currency that was backed, fully backed, like the dollar was by gold after Bretton Woods, that pendulum swings over to this side slowly. We're just going, we're coming up on the 50-year anniversary of Nixon suspending the convertibility into gold. And it slowly swings, and people don't have confidence. They have less and less confidence in it. And then an event or a series of events, it snaps. And man, what took all this time to swing this way goes boom, all the way back over. And you get some new currency that is backed with something again, because it's a total loss of confidence. I don't want to transact in this anymore. I don't want to save in this anymore. I'm going to own Bitcoin. I'm going to own gold. I'm going to go in anything I can that's not dollars because I don't trust it anymore. And so then to get trust in your currency again, to get merchants to use it, to get people to save in it, to get countries to transact in it, internationally, you got to have something that gives it confidence again. So what we're really talking about is a collapse of confidence. We're not there yet. One of the most ingenious inventions yet by the bankers is this dollar index, right? Where they say, well, the dollar was stronger today. Well, compared to what? Well, the dollar index. Okay, well, what's a dollar index? Well, it's 57% the euro. It's about 12% the pound. It's a certain amount in the yen and the Canadian dollar. They're all unbacked fiat currencies. So you're telling me the dollar got stronger today against a basket of similar, pieces of paper that also aren't backed. And if they all devalue at the same rate, Elijah, then relative to each other, nothing changes, right? So it's not so much a collapse of the dollar, again, even versus these other fiat. It's a loss of confidence in that monetary system. That's the moment that's coming.
All right. Well, Craig Hemke, we really appreciate all your insights today. And I guess if our viewers are interested in learning more about everything that you've spoken about today, where can they find you online?
Right. Am I pointing at it? Okay. Right there. tfmetalsreport.com. tfmetalsreport.com. It's great. I mean, it's a shelter in a storm. Here's a great example of how wonderful that my website is. And it's not wonderful because I'm there. It's the people that are on there. Last week, somebody posted something that they had found at Catherine Austin Fitt's website, which was a form that she'd drawn up that if your kid you don't think your college-age student should be vaccinated as a terms and condition of going back to college, well, here's a form you should take to the administrator and have them sign. Well, I would never have found that, but somebody on my website found that. And that's the value of the community. And it's $15 a month for my analysis, but also for access to that kind of community where we're all in the same boat. We're all rowing in the same direction. We all realize, whether you're a Republican or a Democrat or a progressive, liberal, labor, whatever. The math is the math, man. And we got to help each other prepare for it. And that's what we do at TF Metals Report.
tfmetalsreport.com. We'll put it on the screen there. And if people are interested in signing up for our free newsletter to keep up to date with all the interviews we're doing with Craig, you can go to libertyandfinance.com and sign up there. Craig, once again, thank you so much for your time and God bless.
All the best, my friend. Keep going.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.